Welcome back to the deep dive. Today, we are putting on our hard hats, metaphorically speaking, and diving deep into the engine room of, well, a real heavyweight in the U.S. energy scene,
Yeah,
Occidental Petroleum. You know them as OXY on the ticker.
that's right.
And we're not just skimming the surface here. We are meticulously peeling back the layers on their Q3 2025 result operations financials, the works.
Yeah, and looking at their investor slides, it seems like they're not just doing well, they're really pulling ahead, especially in their key areas.
Exactly. And for this deep dive, we've got a pretty solid stack of material.
We do. We've gone through the main Q3 2025 earnings release, the detailed financial schedules, both GAAP and the non-GAAP stuff, which is key here.
Right.
And maybe most importantly, those supplemental investor slides. They've got the operational data and, crucially, those direct competitor comparisons. That's where you really see how OXY stacks up against, say, Exxon or ConocoPhillips.
Okay, so our mission today, especially for you, the listener, is to give you the fastest but still really thorough shortcut to understanding where OXY sits right now, strategically.
Right. I want to pull out the big financial numbers, figure out why they look like they do.
Understand those operational strengths, and yes, we're definitely talking Permian, and see how their capital strategy, that focus on paying down debt, how that's actually playing out in the real world and leading the market.
Yeah, we're trying to get beyond just the numbers to the so what. What do these leading metrics actually mean?
Okay, let's start at the top then, the big picture view. The CEO, Vicki Hollub, her statements usually set the tone. What was the main narrative coming out of Q3? Was it just, we hit our numbers, or something more?
It was definitely more than just meeting expectations. The core message was really twofold. First, exceptional execution, and second, how that execution highlights the strength of their assets. Hollub called the results a testament to the exceptional operational execution of our teams. And she specifically pointed to the strength of our upstream portfolio. Now, you hear stuff like that a lot.
Sure, standard CEO talk sometimes.
Right. But when she says exceptional execution, given the numbers we're about to dig into, it feels like she's directly pointing to those efficiency gains, the better-than-expected production volumes. It's not just fluff.
And beyond just the quarter's performance, she flagged something pretty major strategically, right? The proposed sale of OxyChem.
Oh, absolutely. That's huge.
This isn't just selling off a small piece. It feels like a fundamental shift to really zero in on the core oil and gas business.
Exactly. You have to remember the context. For years, ever since that massive Anadarko deal, OXY's #1 job, the thing that dictated everything, was paying down that mountain of debt.
Right. Deleveraging.
Deleveraging. This OxyChem sale, they're pitching it as kind of the capstone of that whole phase. It's meant to do 3 big things, all connected. First, obviously, strengthen the balance sheet even more, get that debt down faster. Okay. Second, it lets them accelerate shareholder returns. Investors have been waiting for that. Buybacks, dividends, that sort of thing.
Makes sense.
And third, and this is maybe the most crucial part strategically, it frees up capital specifically for what they call high return opportunities within the core oil and gas business. So the Q3 results are kind of showcasing the potential of that core business, which is about to get even more investment focus.
That context is really important. Okay, so let's talk about the engine fueling all this, cash generation. Because strong execution, higher volumes, it should show up in the cash flow, right?
Yeah.
What did those numbers look like for Q3?
Yeah, the cash generation was genuinely impressive this quarter, especially when you consider the capital they were spending, which we'll get to. You have to look at 2 main numbers here, the GAAP operating cash flow and the non-GAAP one.
Okay, let's pause there for a second. For listeners, why the 2 numbers? And why is the non-GAAP one like almost $500 million higher? What's the difference?
That's a great question, and it's super important in energy. So GAAP, generally accepted accounting principles, makes them include all the swings in working capital.
Like inventory changes when they get paid, that kind of thing.
Exactly. Changes in receivables, payables, even physical oil inventory shifts. And that stuff can bounce around a lot quarter to quarter just based on timing. So the GAAP reported operating cash flow was $2.790 billion. Still a good number.
Okay.
But the non-GAAP operating cash flow before working capital that hit a really strong $3.2 billion. Well, $3.199 billion to be precise. Analysts often prefer this one because it strips out those timing-related swings.
So it shows the underlying cash power of the actual operations.
Exactly. It gives you a clearer view of how much cash the wells and facilities themselves are generating, regardless of whether a customer paid a bit late or they bought more supplies that month. That higher non-GAAP number signals really strong, sustainable cash flow from the core business.
Got it. That clarity helps. And then there's free cash flow, FCF. That's the money left after they pay for new projects and upkeep, right?
Yeah.
The deployable cash. How did that look?
Yeah, FCF for working capital, again, using that non-GAAP approach, came in at a very healthy $1.470 billion. The press release rounded it up, called it $1.5 billion.
Okay, $1.5 billion surplus.
Right. And when you set that against their total capital spending for the quarter, which was $1.729 billion, net, you see a business that's basically funding its pretty aggressive growth and keeping the lights on while still generating a massive surplus. And we know where that surplus went.
Straight to paying down debt, fulfilling that long-standing promise.
Precisely. This has been the mantra for years. They reported paying back a pretty remarkable $1.3 billion of debt just in Q3.
Wow.
Yeah, think about that. That's like 40% of their operating cash flow for the quarter dedicated just to fixing the balance sheet. This consistent, aggressive approach brought their total principal debt down to $20.8 billion.
$20.8 billion. Now, that still sounds like a big number in isolation.
It does, but context is everything.
Right. How does that compare to where they were after the Anadarko deal?
Oh, it's night and day. Post-Anadarko, their debt ballooned to around $40 billion. Maybe even a bit more, depending on how you counted it. This whole leveraging process has been, frankly, painful for them, cutting costs, selling assets, but absolutely necessary.
So they're getting closer to that investment-grade rating territory.
They're definitely moving that way. The market perception is shifting, from this highly leveraged company to one that's much more financially sound, disciplined. That $1.3 billion paydown isn't just a number. It's a signal that they're nearing the end of that big cleanup phase. It lets people focus more on the operational strength, less on the financial risk.
Okay, makes sense. Now let's hit the bottom line, the earnings snapshot. Cash flow was strong. What about net income? And how did Q3 stack up against Q2?
Yeah, the earnings showed a really strong bounce back sequentially. That was sort of the story of the quarter financially. Reported net income attributable to common stockholders was $661 million. That works out to 0.65 cents per diluted share.
Okay.
But again, for a cleaner comparison, we usually look at the adjusted non-GAAP number, which strips out any special items. Adjusted income was right there with it, $649 million, or 0.64 cents per diluted share.
64 cents adjusted. It doesn't sound earth-shattering, maybe, until you compare it to the previous quarter, right?
Yeah.
Q3 was really a recovery.
Oh, absolutely. A fantastic recovery story. In Q2 2025, their adjusted EPS was only 39 cents.
39 cents.
Right. And the reported EPS was even lower, just 39 cents, 2 and 6 cents. So jumping from 39 adjusted in Q2 to 64 cents adjusted in Q3, that's what, a 64% improvement quarter over quarter? That's significant. And it wasn't random. It was driven squarely by those two things coming together. Better operational output, meaning more production, and a more helpful market, meaning better crude prices, which we'll touch on. This quarter really proved their execution can deliver serious earnings when the commodity prices give them even a little help.
All right, let's shift gears from the financials to the actual operations. The theme here seems to be beating expectations. Total company production exceeded their own guidance.
Yeah, it did. The total company average production was really robust, came in above the high end of their guidance range, hitting 1,465,000 barrels of oil equivalent per day. MBO.
Up 0.465 million barrels a day equivalent.
Right. And that MBOD metric, it's the standard way the industry bundles oil, NGLs, and natural gas together based on energy content, so you can compare apples to apples. Hitting that level, 1.465 million, that really backs up the CEO's exceptional execution comment. It's a cornerstone number.
So where did that 1.465 MBOD come from? We know the Permian is their big focus, their growth engine.
Right.
How did the different regions contribute?
You nailed it. Geographically, the Permian doesn't just contribute, it completely dominates their U.S. portfolio and, frankly, drives the whole company's growth story right now.
Okay, let's see the breakdown.
All right, for Q3 2025, MBOD Permian came in at 800 mem. Now, that's a big jump from 777 BOD in Q2.
Wow, 30 MBOD sequential growth in the Permian alone.
Yeah, that's significant growth in a basin that size. Shows as new wells are really performing. It's easily the biggest piece of the pie. Rockies and other domestic. That was 288 MBOD, also up a bit from 272 MBOD in Q2. Gulf of Mexico, 139 MBOD, also saw a nice increase from 125 MBOD the prior quarter. International contributed 238 MBOD, just slightly up from 233 MBOD in Q2.
Okay, so growth pretty much across the board, which is good to see. But that Permian jump, 770 to 800 MBOD, that's the headline operationally. Why is that specific 30 MBOD increase so important to the Permian?
Well, it's critical because it shows they're successfully fighting and beating the natural decline curves you get with unconventional shale wells.
Ah, right. Those wells start strong but fade relatively quickly.
Exactly. They decline really steeply, especially in the first year or so. So just to stay flat, you have to keep drilling. To actually achieve sequential growth like this, OXY has to bring online more new production than their entire huge base of existing wells is losing to decline.
Okay.
That 30 MBOD increase proves their drilling program is working efficiently, it's predictable, it's profitable. It pushes back against any idea that, maybe the Permian's best days are over or they're running out of good spots to drill. Clearly they're not.
Let's drill down into that Permian number a bit more. Specifically, the mix. How much of that 800 MBOD was the really valuable stuff, crude oil?
Yeah.
Because a barrel of oil is worth a lot more than the gas equivalent, right?
Absolutely. That's key for revenue. The focus is always on liquids, oil, and NGLs. So looking at their total U.S. oil production first, that climbed nicely from 604,000 barrels per day in Q2 up to 634,000 barrels per day in Q3. That's a direct driver of the better segment income.
And the Permian drove most of that increase.
Oh yeah, the lion's share. Let's break down the Permian liquids specifically. Permian oil grew from 410,000 barrels per day in Q2 to 422,000 barrels per day in Q3. That 12,000 barrel a day increase in pure crude, that's very high value production.
Okay.
Permian NGLs, natural gas liquids, also saw a good lift, going from 196,000 barrels per day in Q2 up to 208,000 barrels per day in Q3.
So the total volume is up, and the mix is tilted heavily towards the more profitable liquids.
Mm-hmm.
They're optimizing for value, not just sheer volume.
Precisely. That's smart execution.
Now, we shouldn't forget the international piece. It's smaller, but it adds diversity, right?
Yeah.
What are the main assets contributing to that 238 MBOD international figure?
Right. International is important for diversifying the portfolio and providing sort of a stable cash flow base. These are often older, more conventional fields with slower decline rates than the Permian Shale. The volume is mostly concentrated in the Middle East. Al Hosn. That contributed 93 MMBOD. That's a key gas asset for them in the UAE. Oman delivered 74 MMBOD. Long history there. Dolphin added 41 MMBOD. That's the big gas pipeline project linking Qatar and the UAE, Algeria, and other international. Made up the rest, about 30 MMBOD.
So these assets, they provide a foundation, maybe smooth out the bumps from the more volatile U.S. shale side.
Exactly. They provide a steady baseline of cash flow. They require different kinds of expertise, different capital plans compared to the high-speed drilling in the Permian, but they're a valuable part of the overall mix.
Okay, so we've got strong operational performance, higher volumes, that's one side of the profit coin. The other side is the market. What prices did they actually get for all that oil and gas? How did the commodity markets treat them in Q3? Did that help drive the earnings rebound?
The market was definitely a tailwind for their main product, oil. And that was absolutely critical for turning the higher volumes into higher income. Their average worldwide realized price for crude oil came in at $64.78 per barrel.
$64.78. How does that compare to Q2?
It was up, a modest but, meaningful 2% increase from the $63.76 they got in Q2.
Okay, a 2% price bump doesn't sound huge, maybe, but when you combine that with the extra barrels of oil they produced and sold, that's where the revenue growth really comes from, right? It's like a multiplier effect.
Exactly right. You sell more barrels, and each barrel gets a slightly better price. The revenue impact gets amplified. That feeds straight into the segment income. Just for context, the benchmark prices were a bit higher. WTI averaged around $64.93, Brent around $68.14. So getting $64.78 realized shows they're doing a pretty good job managing differentials and transport costs to capture prices close to WTI.
All right, what about natural gas? Particularly U.S. domestic gas. We know that market's been tough, lots of supply from oil drilling, keeping prices low. Any relief there in Q3?
They actually caught a pretty decent sequential lift, which definitely helped the bottom line. The average domestic realized gas price was $1.48 per 1,000 cubic feet.
$1.48.
Yeah, which was a solid 11% increase from the $1.33 they got in Q2. Now, let's be clear, $1.48 is still historically a very low price for gas.
Right, not exactly boom times for gas producers.
No, definitely not. But that 11% sequential jump was still helpful. It adds cash flow, helps offset costs, maybe minimizes any losses on the pure gas side of the business.
Okay, and the third piece, NGLs, natural gas liquids. Those prices often track somewhere between oil and gas. How did they fare?
NGLs were actually the one weak spot on the price front in Q3. The average worldwide realized NGL price was $19.60 per barrel, That was actually down 5% from Q2.
Down 5%. Why would that be?
It usually comes down to supply and demand for the specific NGL products like propane, butane, ethane. With record U.S. oil and gas production, you get a flood of associated NGL hitting the market. Sometimes that supply just overwhelms demand or export capacity, pushing down prices. So that NGL dip offset a little bit of the positive momentum from crude and dry gas prices.
Okay, so let's put it all together. The higher volumes, the slightly better oil and gas prices, the weaker NGL prices. How did that translate into profitability for the different business segments, starting with the core, oil and gas?
Yeah, the oil and gas segment was clearly the main engine. Pre-tax income there was $1.3 billion. If you look at the adjusted number, it was $1.322 billion.
Solid number.
Very solid. And the earnings release explicitly says it was driven by those two factors we just discussed. Higher crude oil volumes, mostly from the Permian surge, and those higher realized crude oil prices. It shows OXY is really leveraged to oil prices right now, thanks to that production efficiency.
Okay, next segment, OxyChem, the chemical business they're planning to sell. How did it do, and did the results kind of support that decision to divest?
Yeah, you could definitely say OxyChem's performance underscored the logic behind selling it. Pre-tax income was only $197 million.
Much more?
Much smaller, and it was actually down compared to Q2. The reasons they give were mainly market-driven, lower prices and lower sales volumes for most of their chemical products. They did manage to offset some of that internally with better raw material costs, but overall, the cyclical weakness in the chemical market dragged the segment down.
So you've got a business segment that's more cyclical, maybe lower growth, competing for capital with this high-performing oil and gas machine.
Exactly. Divesting it really streamlines the company. It lets them focus all that capital and management attention on the Permian and other upstream opportunities where they're clearly getting better returns and showing market leadership. It removes that non-energy market volatility.
It makes perfect sense.
Yeah.
Okay, last segment, midstream and marketing. This is the pipelines, the logistics, and also where their newer low-carbon ventures like carbon capture sit. How did that segment perform?
Midstream and marketing actually had a pretty strong quarter, relatively speaking. They reported $93 million in pre-tax income. And notably, they actually beat the high end of their own guidance for adjusted income in this segment.
Okay, beat guidance, but you sound like there's a but coming. Was it down compared to Q2?
It was slightly down sequentially from Q2, even though they beat their Q3 forecast.
How did that happen? Beat guidance, but still down quarter over quarter.
It was kind of an interesting mix of factors. The main reasons for the sequential decrease were, first, external market stuff. Specifically, lower Waha to Gulf Coast natural gas spreads.
Okay, unpack that for us. Waha to Gulf Coast spreads. Why does OXY care?
Sure, Waha is the big gas hub out in West Texas, right in the heart of the Permian. The Gulf Coast is where a lot of that gas needs to go, either for industrial use or LNG exports. The spread is simply the price difference between Waha and the Gulf Coast.
The profit margin for moving the gas.
Exactly. OXY has pipelines and marketing operations designed to capture that spread. When the spread shrinks, it means there's less profit in transporting the gas, maybe because there's more pipeline capacity available, or local prices are converging for other reasons. So weaker spreads hit their marketing income.
Got it. What was the other factor driving the decrease?
The other factor was actually internal investment. They cited higher expenses because they ramped up activity in their low-carbon venture businesses. They're spending money now to build out things like carbon capture infrastructure. That spending lowers the segment's income in the short term, but it's aimed at creating future value and cash flow streams.
Okay, so weaker transport margins, but offset by strategic investment. Was there anything positive that helped them still beat their guidance?
Yeah, there were a couple of things helping out. They got a boost from higher prices for sulfur, which is a byproduct they produce at their Al Hazen facility internationally.
Sulfur prices. Interesting.
Yeah, it's a niche market, but it helped. And maybe more importantly, their income from their equity investment in WES, that's Western Midstream Partners, a separate company they have a large stake in that contributed a solid $156 million in Q3. So even with softer gas spreads and higher spending, those partnership earnings and byproduct sales were enough to push them over their guidance number for the segment.
All right, so we know OXY generated good cash flow, paid down a lot of debt. Well, let's look at the other side of the ledger, spending. That $1.729 billion in net CAPEX for the quarter, Where did that money actually go? This tells you where their priorities really lie.
Yeah, the spending breakdown is crystal clear about their strategy.
Yeah.
It is all about the Permian. The biggest chunk by far was oil and gas CAPEX, which was $1,299 million on a GAAP basis, just under $1.3 billion.
Okay, and within that, $1.3 billion for oil and gas.
Here's the breakdown. Permian got $812 million. Think about that.
Yeah.
That's roughly 62% of their entire oil and gas budget poured directly into the Permian.
Wow. Undisputed focus.
Absolutely. They're putting the money where the returns are demonstrably highest, as we'll see in a bit. Rockies and other domestic received $169 million. Gulf of Mexico, $89 million. International, $125 million. And exploration drilling, looking for new stuff, got $104 million.
That Permian concentration is really stark. What about CAPEX outside the direct oil and gas extraction, chemicals and midstream?
Right. The chemical segment, OxyChem, still needed $252 million in CAPEX during the quarter, which, again, just reinforces the logic of selling it, right? That's $250 million that will soon be freed up, presumably to go into the upstream business or maybe accelerate debt paydown even more.
Good point. And midstream?
Midstream and marketing CAPEX was $188 million. That lines up with what we saw earlier, the higher operating expenses in that segment. It reflects that ongoing investment in infrastructure and, importantly, those low-carbon ventures they're building out.
If you look deeper into that CAPEX qualitatively, how is it split? Is it mostly just maintaining current production levels, or is it heavily weighted towards growth and expansion?
They do categorize it between growth and sustaining CAPEX. In a shale play like the Permian, you have to spend a fair amount just to stand still, right? To offset those natural declines.
Right, the treadmill effect.
Exactly, but the fact that they achieved that significant sequential production growth going from 770 to 800 mid per boe in the Permian proves that their growth CAPEX component is working really well. It's more than offsetting decline. In terms of what they're spending on, the big buckets are drilling and completion, the actual cost of making the hole and fracking it, and then facilities building, the pads, pipelines, processing equipment needed to handle all that new production.
And geographically, within the Permian, are they spreading it around or focused?
Oh, very focused. The slides make it clear the spend is concentrated in specific areas.
Yeah.
Primarily their acreage in New Mexico and Texas, specifically within the Delaware Basin part of the Permian. They're not sprinkling money everywhere. They're hitting their known sweet spots hard.
Okay, so disciplined capital allocation is one part of the efficiency story. The other part is controlling operating costs. Yeah. How are they doing there? The key metric is usually lease operating expense, or LOE, right? Cost per barrel produced.
Yes, and this might be one of the most impressive parts of the story, showing strong internal management. LOE is basically the day-to-day cost of running the wells, maintenance, labor, power, water handling, etc.
Okay, what was the number?
For Q3 2025, the total oil and gas LOE was $8.69 per barrel of oil equivalent, BOE.
$8.69. How's that trending?
Well, the total includes international, which is higher cost. The really interesting story is the U.S. segment LOE. U.S. LOE dropped sharply in Q3 to just $8.11 per BOE.
Wait, $8.11. Didn't that start the year quite a bit higher? Can you put that drop in context?
It's a hugely significant improvement, and it directly backs up that exceptional execution line from the CEO. Think about this. Their U.S. LOE was $9.05 per BOE back in Q1 of 2025.
Over $9.
Right. Then it improved to $8.55 in Q2. Now it's down to $8.11 in Q3. That's nearly $1 per barrel saved just over the course of 3 quarters.
$1 per barrel. When you're producing over 1 million barrels a day in the U.S., that adds up incredibly fast. Straight to the bottom line. Yeah. What drives that kind of rapid cost reduction?
It's usually a combination of things. First, economies of scale as they bring more highly productive wells online. Those fixed operating costs that spread over more barrels. Second, continuous improvement, getting better at logistics, managing water more efficiently, maybe using less expensive power sources. Third, just relentless cost management, pushing suppliers, optimizing chemical programs, using predictive maintenance to avoid costly downtime.
So this efficiency gain makes them fundamentally more profitable than competitors who might have higher operating costs, especially if oil prices stay in this, say, $60 range.
Absolutely. It gives them a structural cost advantage. And how does that U.S. cost compare to their international operations? The contrast is pretty stark, actually, and it further reinforces why the U.S., particularly the Permian, is the focus. International LOE was significantly higher at $11.65 per BOE.
Wow, over $3 more per barrel.
Yeah, It highlights the advantages of operating at scale in the U.S. unconventional plays. You've got a highly competitive service sector driving down costs, a generally supportive regulatory environment compared to international projects, which often involve partnerships, more complex logistics, different fiscal terms, etc.
Makes sense. Okay, quickly, what about the other cost components? Depreciation, transportation.
Right, we should mention those. Depreciation, depletion, and amortization, or DD&A, that's the non-cash charge, reflecting the cost of finding and developing the assets spread over their life. That came in at $13.63 per BOE for total oil and gas.
Okay.
And total oil and gas transportation costs, getting the product from the wellhead to the market, that was $3.03 per BOE. This shows the benefit of having integrated midstream infrastructure. They control more of that cost.
So solid cost control across the board, but that sharp drop in U.S. LOE is the real standout.
Definitely. It shows they're not just drilling good wells, they're operating them more and more cheaply over time. That's key for sustainable profitability.
Okay, now we get to what, for me, was the most compelling part of their investor presentation. This moves beyond just OXY's internal numbers and really puts their performance in context against their peers. We're talking about head-to-head competition in the Permian's Delaware Basin.
Yeah, this is where OXY basically throws down the gauntlet. They're not just saying they're good, they're using third-party data to show how much better they are than some very, very capable competitors.
Who were they comparing against? And what data did they use? That's important for credibility.
Absolutely. They use data from Enverus Prism, which is a widely respected industry data source. And the peer group wasn't cherry-picked. It included 15 big names. We're talking ExxonMobil, XOM, Devon, DVN, ConocoPhillips, EOG Resources, basically the A-list of Permian operators.
Okay, strong peer group, independent data. What were the specific rules for the comparison to make sure it's apples to apples?
Good question. They kept it focused and fair. They looked only at horizontal wells, the modern standard, with lateral lengths over 500 feet. They only included wells brought online since January 2024, so it's recent performance. And crucially, an operator had to have at least 15 wells in that data set to be included.
So no basing it on one lucky well, it's average program performance.
Exactly. Comparing recent significant drilling programs in the core of the Delaware Basin.
All right, the moment of truth. How did OXY stack up on 6-month cumulative oil production? That's a key measure of early well performance.
They didn't just edge out the competition, they dominated. OXY's average 6-month cumulative oil production, measured in thousands of barrels MBO, was 38% above the average for the Delaware Basin wells in that peer group comparison.
38%, that's huge.
It's massive, and when you look at the chart they provided, OXY is visibly way out in front of all 15 of those named peers. They are getting significantly more oil out of the ground in the first 6 months than their biggest rivals, on average.
Okay, that's impressive for the first 6 months. But does that advantage hold up over time? Does it suggest better long-term well design, or do the others catch up? What about the 12-month cumulative number?
This is where it gets really compelling for their long-term efficiency story. The advantage absolutely holds up. OXY's average 12-month cumulative oil production was 35% above the 12-month basin average for that same peer group.
Still 35% ahead after a full year.
Still 35% ahead, and again, the visual shows them leading the pack, including companies known for their technical prowess. Maintaining that kind of lead, 35-38% over a large group of sophisticated operators for 6 to 12 months. That's not just a good quarter. That signals a real, durable competitive advantage.
It feels like the core takeaway. What does this sustained outperformance, 38% better at 6 months, 35% better at 12 months, actually imply? What's going on under the hood to deliver that?
Yeah, this is where you have to connect the dots. This kind of consistent, large margin outperformance points to what analysts sometimes call a competitive moat. It's likely not just one single thing, but a combination of factors executed exceptionally well. I'd break it down into maybe 3 key areas.
Okay.
1, superior rock. They likely have control over, or are just better at identifying and targeting, the absolute best geology within the Delaware, the sweet spots with the best porosity, permeability, and oil saturation. They might just understand the subsurface better than others in their specific areas.
So good acreage selection and targeting.
Right. 2, drilling excellence. That 35% plus lead suggests they are masters of precision horizontal drilling, getting that wellbore placed perfectly within the target zone, staying in that zone for the entire lateral length, drilling it efficiently. Even small errors there can really hurt early production. OXY seems to be nailing it.
Okay, better drilling. What's the third piece?
3, Completion optimization. This is probably where a lot of the secret sauce lies. How they frack the well. The design of that frack job, the type
Right.
and amount of fluid, the amount and type of sand or proppant used per foot, how they space the frack stages along the wellbore, all of that is critical for creating the network of fractures that lets the oil flow. OXY's recipe is clearly generating much more effective drainage from the reservoir compared to their peers, on average.
So if they're getting 35% more oil for roughly similar well costs compared to the basin average, that fundamentally boosts their capital efficiency, doesn't it?
Massively. Think of it this way. If the average well costs, say, $10 million and produces X barrels in the first year, OXY might spend that same $10 million but produce 1.35X barrels.
They get way more bang for their buck.
Exactly. Every dollar they invest in drilling in the Delaware generates a significantly higher return than it does for their average competitor. This superior well productivity is the engine driving their capital efficiency, allowing them to generate more free cash flow, pay down debt faster, and sustain production growth even if overall CAPEX is constrained. It turns their story from just paying down debt to highly efficient, profitable growth engine.
And this really puts that planned OxyChem sale into perspective, doesn't it? They're shedding a business that's lower margin, more volatile, to pour potentially more resources into a core oil business where they are demonstrably, verifiably crushing the competition.
It creates a potentially powerful synergy, right? The capital currently going into OxyChem, hundreds of millions a year, can now be redirected into the most productive basin in the U.S., deployed by arguably the most efficient operator in that basin based on this data. That's why the market is watching this so closely. They're already winning, and now they might get more resources to press that advantage. Hashtag tag outro.
Okay, so wrapping up this deep dive into Occidental's Q3 2025, it really paints a clear picture, I think. A company shifting from just surviving and paying debt to really thriving on efficiency and growth. Let's recap the main takeaways for everyone listening.
Yeah, the core themes are definitely that disciplined execution meeting dominant operational performance. They consistently beat their production guidance, hitting that 1,465 minnow BOD total, driven hard by that Permian growth, up 30 men BODs sequentially.
Right.
And they combine that output with really impressive cost control. That sharp drop in U.S. lease operating expenses stands out, getting down to $8.11 per BOE from over $9 earlier in the year. That's real money saved.
And that efficiency, combined with okay prices, led to strong cash generation, that $1.47 billion in free cash flow before working capital.
Which they immediately plowed back into paying down debt, $1.3 billion worth, getting that principal down to $20.8 billion. They are really making strides on strengthening the balance sheet, nearing the end of that big post-Anadarko repair job.
And then, maybe most strategically, that third-party data confirming their leadership in Delaware Basin well performance.
Absolutely. That 35% to 38% advantage in cumulative oil production over major peers, that's not just noise. That's evidence of a structural competitive advantage. It proves their technical teams are delivering superior results where it matters most.
That feels like the bedrock of the whole investment case right now. And layered on top of that is the pending OxyChem sale, explicitly aimed at freeing up capital to reinvest in that already dominant core oil and gas business.
So we'll leave you, the listener, with this final thought to chew on. The data clearly shows OXY already leads the Delaware Basin pack by a huge margin, 35% plus, in well productivity. So the question becomes twofold. First, if OXY takes the significant cash infusion from selling OxyChem and plows it back into accelerating their already superior Permian drilling program, what did that do to the overall Permian supply picture? Can they accelerate that much efficient production? And second, maybe more pointedly for the competition, if you're Exxon or Chevron or Devon and you're lagging OXY's well results by 35%, what concrete steps can you even take to close that gap, especially when it seems rooted in a combination of prime acreage and superior technical execution? How do you compete with that sustained lead?
It definitely sets the stage for potentially an even more focused, accelerated growth phase for OXY, fueled by that efficiency advantage. They're shifting from playing defense with the balance sheet to potentially playing offense with their best-in-class drilling program. That combination of financial flexibility and proven technical superiority could really reshape the competitive dynamics in the Permian for years to come.
Indeed. It's going to be fascinating to watch how that unfolds. Thanks, everyone, for tuning into this deep dive. We'll catch you on the next one.